Hey guys, how are you doing? In today's video, I want to talk to you about a candlestick pattern that works pretty much every single day of the week. You can trade using this candlestick pattern at pretty much any given time of the day, and you can trade this with as many markets as you want. I personally use it for the Nasdaq, for the ES, CL, meaning crude oil, but also gold. And we'll get right into it because you could just test it out for yourself. I don't expect you to believe me, obviously. Test it out for yourself and you will see how amazing this is. So, to get right into it, what is the difference, in your opinion, between, and I'm going to draw this up beautifully for you guys, this candle right here, and, for example, this candle, but also this candle, or these candles right here? What is the difference? Well, it's actually pretty obvious if you just look at it visually. The first candle that we talked about looks like this, right? So we have a body, which is this part right here. And then we have pretty short wicks at the bottom and at the top, right? Now, these candles that I mentioned down here are quite different. They have long wicks and relatively short bodies. So they look more like a hammer stick, right? Now, these candles tell a story. Every single candle tells a story because there's a reason why they look the way they do. And if you combine this knowledge with some further knowledge on liquidity and where to look for these candles, because you cannot just use them randomly using what I'm about to show you, then you can find amazing entries all day, every day. So let's first talk about what these candles actually mean. If you have a candle with basically just a long body and some small wicks at the top and at the bottom, that means that this candle was kind of in balance, meaning we had buyers, B, beautiful done, and we had sellers, okay? And the price most likely moved up and down, up and down, up and down, then maybe all the way back up because this is a 5-minute candle. You'll find the same on daily charts, on hourly charts, on 1-minute candles. It doesn't really matter about the time frame. I just like the 5-minute charts because it's less busy as 1-minute charts, to be fair. However, this works on any given time frame. Okay, so if we have a candle like this, that means that it was a normal price action. Price traded back and forth, back and forth. And to give you an example of how this actually looks like, I open up this footprint chart for you guys right here. So this right here was the candle that was balanced. Long body, you can see it right here, and some short wicks at the top and at the bottom. And you can see it if it just looks inside this candle, which the volume profile allows us to do. Then we can see that we had buyers and sellers. Price most likely went up and down, up and down. So the price action was healthy. It was normal. But then we have candles like these down here. And you can see the difference. Just look at the volume. 0, 0, 0. So we had a one-sided auction down here. And most likely, if we would take a look at how this candle formed, we obviously started off up here. Then we went down, most likely quite aggressively. This is what this indicates. And then we came back up and we closed up here. So the candle, most likely, if you take a look at it on a 1-minute chart or maybe on a 30-second chart, it doesn't really matter, just went down very rapidly and then came back up. And that is why this hammer stick candle here, or this long, long wick, basically formed. And this is beautiful because we can use this to find amazing entries all day, every single day. And once you know how this works, and once you can combine this with the knowledge on how liquidity works, how the market works, then this will give you amazing entries for a lot of trades every single day. Okay, so let's actually try to put this into perspective, and I will show you exactly a strategy that you can use that actually works and that I pretty much use every single day to trade profitably. So in order to use these candlestick patterns, or the knowledge of how these candlestick forms and how to find entries using these candles, you need to know how the market moves. So the market moves up and down, obviously, but there's reason why the market moves up and down. So in its essence, the market has one goal. It wants to transact as many contracts as possible during any given day. And it can do that at two different price levels. It can do that at first at levels of liquidity. So what you guys know as support and resistance most likely is nothing else than liquidity. So for example, if we have a normal range that you most likely have seen, then we have resistance up here, right? Resistance, beautiful. And down here we have support, beautiful. So let's say we have a bunch of traders. This range has been going on for quite a few minutes, maybe 30 minutes, maybe an hour, maybe a day. It doesn't really matter because the time frame does not matter. This is universal. Price is fractional, meaning if something works on a larger time frame, it should also work on a smaller time frame. Okay, so let's say we have this range here, and someone buys down here because he expects that the market goes back up. Okay, so he places a buy order here, and what does he do? He most likely puts a stop loss, meaning a sell order, down here, right? Okay, let's say more people get in here, boop, and even more people put their stop loss down here because this is support, right? This is supposed to withhold and basically sustain all of this range. But on the other side, you have the same story going on with people going short here, meaning they sell right here, and you always need to have the counter position to get out of your trades, meaning they will put their buy stop loss all the way up here. So what this basically means is we have a bunch of sell orders here, here, and also here, a bunch of buy liquidity here, sell liquidity down here, but the market cannot move further up or further down. And why is that? Well, because the market doesn't have fuel to the fire. The market needs fuel to break out of either a high or a low. So in order to break this high, what do we need? Just think now, what do we need? We need to buy up all of this liquidity down here. So let's say you're a big market participant, you're a hedge fund, you're a big bank, institution, it doesn't really matter. And you see this range. It kind of would make sense to push the market below this level of support, right? To push it further down. You buy up all of this liquidity because there's a bunch of people who want to sell to you down here, right? So you can buy up hundreds, if not even thousands of contracts down here. And then suddenly the market has fuel to the fire, a lot of demand that just came in. So the market just goes all the way up here. And where does the market stop? Interesting. It stops right here where there's more liquidity at the level of resistance because all of the people or just one market participant who bought these contracts down here, he needs to get out of his position, right? And where can he get out of his position? Well, where there's a bunch of buy orders because he now needs to sell these contracts that he just bought. And that is why the market likes to go from one level of liquidity to the next. So to put this in perspective and to show you exactly how this works, you can and it's very basic. It's very, very easy. You can take a look at how the market forms structures. So to give you an example, the market most likely had some liquidity below this level, right? Because the market sold off the entire day and then here we rebounded. So people who went long right here, where do they have the stop losses? Somewhere here, right? Interesting. And people who went short here, where do they have their stop loss? Well, most likely somewhere here or maybe even here, which we'll get into in just a moment. Okay. Or take a look at this right here. Or maybe even, let's make it easy. This is a picture perfect example. Picture perfect example. Look at this. We had previous resistance. We broke through this resistance. And now all the price action traders come in here and say, hey, this is support, right? And it was for at least a moment, for about 10 minutes. And then the market came further up. We broke this high. But the market couldn't go further up than this. It couldn't because it didn't have enough fuel to the fire. But now the market did the following. We came all the way down here. And what is down here? There's liquidity, right? Interesting. And take a look at the candle. How does this candle look like? Okay. Now you get to connect the points. You get to see how this actually works. We have liquidity down here, which is sell liquidity, right? So imagine you are a big hedge fund, you're a bank, whatever you may be, or just a retail trader. You know there's a bunch of liquidity down here. The market has been trending up anyways. We broke through this high, but we cannot go any further. So in order to break this high right here, we need to buy a lot of contracts. And where can we buy them? At levels of liquidity. And the cool thing is, this happens fast because the market participant, the big market participants, just needs to push the market lower than this level. And here there's all these stops, meaning the market can just go boop, boop, back and forth. So it's basically one move, a very fast move down, and another fast move up. We are back here, and then the market can take off. And what did we learn at the beginning of the video? If a price action is fast, it's not normal, it's an abnormality to the market, like this. Candlesticks like these form. And that's a candlestick pattern. So if you check for levels of liquidity, just by thinking about where would it make sense for market participants to get in, where would it make sense? Then you can see, okay, if I combine this knowledge with this candlestick pattern here, or maybe even here, I can find an entry here to the long side, or potentially even an entry here to the short side. Because think about it. The market went all the way up here, but we couldn't go higher, right? We couldn't break this high. Okay, so the market came lower, and the one market participant, or maybe multiple, doesn't really matter. Thousands of contracts were probably bought down here. Where can they sell these contracts for profit? At the next level of liquidity. So somewhere up here, above this high. And take a look at this candlestick pattern again. It's a long, long wick. It's a hammer stick candle. And you can use this knowledge. And if you combine just these two things, you're golden. This is a very, very easy way to trade. And if you want to be more precise and you want to find entries exactly at these lows here, then you can use a tool called Bookmap. I have a bunch of videos on my channel where I just trade myself. And once I see that the market goes below this level right here, or below or above this level, I'm going into Bookmap. I want to see this in the order flow. So Bookmap is just basically lets you look inside these candles. It lets you look inside of what is happening inside these candles. And once you see what you need to see, then you get in here and you sell all the way up here, potentially here somewhere in the middle, just for a nice profit. And you can do this once a day, twice a day, 3 times a day. It doesn't really matter. There's chances every single day with this candlestick pattern. So you combine the knowledge of what do these candlesticks mean with liquidity, potentially even the volume profile, and test it out for yourself. Just test it out for yourself. I have a bunch of videos about liquidity on my channel if you need further knowledge about that. But don't believe me. Test it out for yourself and you will see how amazing this is. So guys, without further ado, I have a plane to catch right now. I'll see you guys in the next video and I wish you some good profits. See you. Bye-bye.